Hi everyone, welcome again to another financial analysis video. I'm Moeed Amin with my colleague Ted Wainman. Today we are looking at Escape Hunt. Escape Hunt essentially their companies around, they provide kind of entertainment, and a lot of their business comes from corporate entertainment, not just consumer-based entertainment. But what they do is really cool because I've experienced this and I really like it. Is they do something called escape rooms. Basically, these are rooms around the city of London. I don't know if there are any other cities that they do. So far, I've experienced the ones in London, but essentially there are puzzles, riddles, things like that when you go into the rooms, and it gives you the key that unlocks to the next room, etc., until you find the prize, and then you can get out of the whole room. And actually, it's a lot of fun. So we're looking at this company. Actually, we received a recommendation, a request for this company from one of our viewers. So thank you for that request, Ali James. Here is your video, and we're more than happy to do so. Just before we go into the finances, quick note on the stock price. And if you'd invested when they floated in 2016, right now you would be sitting on a significant loss. Not really a surprise there, given the fact that this is a company that's been very badly affected by COVID, right? It's a person-to-person interaction. However, they did pivot, and they did do a decent job of pivoting to making virtual escape rooms. So we're going to have a look at the finances to see if that has had any form of impact, and see if they've outlined that at all. However, what we do see is that if you invested a year ago, you would be sitting on about 5 times gains, right? Significant gains. So again, there is that element of almost a recovery stock that this seems to fall under. So we'll dive into the numbers for you right now. But before I do so, don't forget to like, share, subscribe, especially if you're one of the viewers like Ali James, who made this request, and we're getting a ton of those. If you want to get notified of the company that you wanted us to analyze, you will receive that notification if you are a subscriber. So Ted, take it away. Let's share what we have found out in terms of the finances of this company.
Okay, thank you very much. So good to see you, Moeed, again. I haven't had the privilege of experiencing an escape hunt, but I know quite a few people who have, and everybody just raves about it. It says it's absolutely fantastic. So the experience sounds great, and here are their accounts on their website for 2020. We need to sort of scroll all the way down through the accounts to find the financial statements that we are interested in. So here is their financial statements, the consolidated income statement. And what we notice, first of all, is that there is a massive drop in revenue. Now, we kind of expect a big drop in revenue, obviously due to COVID, 46% though. So very, very big drop in revenue. The cost of sales is in here. So this is the cost of actually running those escape rooms. So they are, they are running at a profit. And the profit margin is about 70%. So these are pretty profitable products that they're actually running. However, it costs a lot of money to run this business. So they've got very, very high overheads. These are the administrative expenses, sometimes referred to as SG&A. That's the sales, general and administrative expenses. That'll be marketing in there as well. So they have a lot of effort in terms of marketing, in terms of getting people, once people are in there, it's got a very profitable product, but there's a big effort to get people actually in there or to actually run the business. And, they're running in rooms. What we don't know is the rent of those properties, for example, is that sitting in there, or do they consider the rent to be sitting in there? Okay, so we're not absolutely certain, but whatever we do, we can see that these guys are making an operating loss. Okay, so they are making an operating loss of about 240% because of these high overheads. That's a loss of 6 million on turnover of 3 million. Even in the previous year, they're making a loss of 6 million on turnover of 5 million. Okay, and you'll notice here that the administrative expenses, they've managed to reduce them, but they're still, they're still making a loss. So this is a loss-making company, and if you're loss-making, at some point you need to be turning it around and making a profit. You cannot make a loss forever. So we hope that there are plans, and if anybody knows the kind of the sort of the route to profitability, then please do leave a comment in the comments box. What we've got here is lots of other charges which are kind of giving detail to the operating loss. It's just helping us to kind of break down that operating loss. There is the operating loss there, which they've actually articulated here. So this is a detail of the numbers. A lot of amortization going on in there. So this is amortization of intangibles. You remember intangibles, things we can't touch. So that'll be amortization of goodwill, and goodwill because they've been acquiring other businesses. And the answer to your question, Moeed, is yes, that they are all over Europe. So it's not just in London. They're trying to go global, and they are buying similar companies and bringing them under the Escape Hunt brand and sort of methodology. So lots of amortization, lots of depreciation. These are non-cash expenses. So summary is right down the very bottom line, a comprehensive loss. And that definitely is a very, very comprehensive loss. 6 million this year, 6 million last year. So even pre-COVID, 6 million loss, and in COVID, 6.6 million loss. So there's our profit and loss account. Let's go and look at the balance sheet and see how strong the company is. So just scroll down a little bit further. Here we go. So here's the balance sheet, the statement of financial position. The non-current assets are the things they need to run the business. Property, plant and equipment. So this will be 3 million of, this is all the kind of probably the puzzles and all the computers, tables, chairs. There'll be some back office assets in there. Not a huge amount actually, 3.8 million. Remember, they're going to rent all their buildings, so they don't own their buildings. They'll rent the rooms, and I expect that rent is part of the administrative expenses. They've also got some right of use. This is kind of leases, like photocopiers, for example, which they lease. But what we do see is that there has been a reduction. So there has been a fall in the non-current assets. Below that, we have the current assets. There's no stock because they don't sell anything. They sell an experience. Trade receivables. Interesting enough, trade receivables look reasonably low. We kind of expect that because you're going to pay up front. Even so, there are some corporate customers, quite a lot of corporate customers in there, and so on average, it looks to me like it's taken them about 38 days to collect the money in. That's what the numbers are telling me, which is, all right, but not great. And they got a lot of cash, so they do have a lot of cash sitting on the balance sheet. They had a lot of cash. They've still got a lot of cash, so they're keeping their powder dry, so to speak. Looking at the bottom half of the balance sheet, current liabilities, trade payables. Trade payables look reasonably high to me. So for a company that's only turning over 2.6 million, to have trade payables of 600,000 is quite high. So we might just wonder whether they are kind of using their suppliers to try and finance themselves. However, at the kind of the headline level, current assets to current liabilities, liquidity does not appear a problem. I'll just read you out the actual ratio of that, if I can find it. So that current ratio is 1.54. So that says for every £1 we owe and have to pay soon, we've got £1.54, either as cash or coming in as cash soon. So short-term liquidity doesn't look like a problem. The final part of the accounts down here, we'll notice what jumps out at us is this convertible loan note. Okay, so this is the debt which is financing the business. There wasn't any last year. There is this year. It's a pretty small number, but it's kind of just a highlight that says that actually some of the financing is now coming from loans which are convertible into equity. Now, we don't know the terms of those loans, those convertible loan notes. We may get some more information in note 25, but effectively this is people who are now investors, but they're saying, yes, we will invest, but we're going to invest as debt, which is lower risk than equity, with the option to change into equity if things go get better. So that's just a highlight there, which is, I thought was quite interesting. And then from the equity perspective, this company, well, they're loss making. They've been making a loss for a long time. This is the money that the shareholders have put in, and this is the accumulated loss. So the accumulated loss even last year, so they were sitting at the beginning of the year on 22 million of loss, and that's gone up to 28 million of loss because of that extra 6 million during the year. So they've been making losses, and they've been making losses for a long time. You'll notice that this number has increased. This number has increased. So it looks to me like they are still issuing shares, and we will be able to confirm that in the cash flow statement. So let's go to the cash flow statement and look at that. We don't really need to look at the movement in equity because they're making a loss. They're obviously not paying out any dividends. They're not that's anywhere near that stage yet. So the first part of the cash flow says that they are making, here's the loss, and they are making negative cash. So the cash used in operations, let me just scroll that down a little bit so we can see the full picture. So the cash used in operating activities, that's this number down here, that is a key number. They are burning cash. So they've been burning cash in previous years. They're burning cash in this year. Given their cash level, they've got about 2 years worth of cash, which they can burn through before they run out of cash. So you know, they've been making a loss. A lot of that loss is down to what we call these non-cash items, depreciation and amortization. But even so, they are still, if you ignore that depreciation and amortization, they are still making a loss. Okay, so they are, you know, negative cash flow is not a good sign. There's a little bit of investment going on. Here's the property, plant and equipment investment. You'll notice that the investment, purchase of property, plant and equipment, this is much lower than the actual depreciation, which means that they've kind of, you know, they've made a big investment up front. They've got lots of assets which they're depreciating, and they are, you know, adding to it, but they're not adding to it at the rate that they are depreciating, which suggests that, you know, they are again just being a little bit more reticent, a little bit more careful given the COVID situation and the uncertainty. And then finally, the cash flows from the financing activities. So here we go. They have been raising money as we expected, as we saw in the equity section of the balance sheet. They have been raising money from the issue of shares. I would expect that to continue. So I would expect that if you are a shareholder, then you're going to see your shareholding continuing to be diluted, because these guys are burning cash, and they're going to need to carry on raising money. There's the convertible loan note that they issued, some costs in share issues, etc., etc. So there's the cash at the end of this year. There's the net cash from financing activities, giving the net increase in cash. So in effect, they what we're saying is that they got cash burn. They are investing, but they are using the money raised from shares to basically cover their cash loss and to finance their capex. They've got a little bit of cash left over, and they end up with about £2.7 million sitting on the balance sheet. So what are our conclusions of this? Well, you know, it's a loss-making company. Let's put up the share price so that we can see that. You know, so as you mentioned, you know, if you'd been an early stage investor, you'd have seen a whopping great loss on your investment. It's come all the way down. It really just hit a complete low. I mean, you know, that is well, when did COVID? You know, that's really kind of, you know, the nadir of COVID. And this has been a recovery play. So this has been a kind of, you know, as the economy is going to open, so people are going to go back again, and it's all kind of positive, good news. But then since then, it's kind of wobbled a little bit. Looking at these numbers, I think that, you know, this increase here, this is just sentiment. This is just people thinking, wow, there's a recovery. What stocks can I buy in order to kind of, you know, to run with that recovery? And they'll buy anything that was hit and will potentially come back. But looking at the fundamentals of this company, they are by no means out of the woods at all. They are trading on a, you know, their market cap is 30 million. Their balance sheet is 2.8 million. So it's basically all goodwill. You know, there is no P ratio because there's no earnings. They're trading on 11 times sales. Remember, sales have halved, so you'd expect them to come back post-COVID. So even so, that's still trading on, you know, 5 or 6 times sales. You know, what I haven't really worked out is, you know, those administrative expenses, we'd expect if they can keep those admin expenses fixed and grow the business, grow the top line, then, you know, they can come through to profitability. But if the admin expenses includes the rent of the rooms that you actually, you know, experience, then I think that, you know, that's going to be a, you know, a real challenge. So I haven't seen the business model. I'd be interested to know, you know, at what level of sales they think they need to hit in order to break even and start generating bottom line profit. If anybody knows that, do leave it in the comments, because that to me is the crucial, you know, at what point are they going to hit profitability, and how much cash, how many times are they going to have to go back to the shareholders to raise money in order to get to that level? And I'll give you an analogy here. I'm a big fan of With Nail and I, one of the greatest movies ever. And there's a lovely comment from a chap called Danny towards the end of the movie, who likens the end of the 60s or the end of the 70s to the holding on to a rising balloon. He says you grab hold of a balloon, it lifts you off the ground, and you start to rise higher. And at some point, you're going to let go. The problem is, the longer you hold on, the more it's going to hurt when you let go. And you can sort of start to see this sort of the equivalent with a company like this, that you're an investor. The investors are continuing to put money in. The more money they put in, the further away they are from the ground. The more money they then need to carry on funding this business to get to that kind of that profitability. So, you know, we have seen an increase. You know, if you got in at the bottom and you got out at the top, then you're very clever, but it's a fool's game to try and time the market. You know, where does it go from there on in? You know, if the fundamentals start to come into play, I think this company still has a lot to prove financially. So experientially, fantastic company. Financially, put it this way, not for me right now. Thank you, Moeed.
Yeah, I was going to say the same. As a consumer, as a customer, good experience. As an investor, in my opinion, not so great, especially if you're a long-term value investor. So that is the analysis on Escape Hunt, which was an interesting one. Again, if any of you have any comments, if you are very knowledgeable about this business or the industry, do leave your thoughts in the comment section. We welcome more information for sure. And of course, don't forget to like, share, subscribe, especially if you've left a comment for a company you want us to analyze. You will get notified of when that video is out. So until the next video, Ted, thank you again. That was a great analysis. And we'll see you all on the next video. Bye for now.
Great to see you, Moeed. See you later.